All right. Tuesday, January 13th, 2026. Let's get right to the closing print. The scoreboard suggests we went, well, utterly sideways, but the action underneath, that tells a very different story.
It really does.
S&P 500 closed up a negligible 0.08%. The Nasdaq 100, it dipped 0.12%, and only the Dow showed any real momentum, gaining 0.21%, a tight neutral close.
And that neutrality, honestly, it's a mirage. It's designed to deceive.
How so?
If you just glance at those headline numbers, you miss the entire story. The narrative today was pre-data paralysis.
Okay.
Price was pinned entirely within Monday's range. It was a choppy mess, yes. But the key is why the desks were on the sidelines.
CPI tomorrow morning, 8:30 a.m.
Exactly. They're just refusing to take on new risk ahead of that release.
Yeah.
The first real stress test for this 2026 rally.
So if inflation surprise is hot,
Then the modest bid we saw dissipate this morning will look like a distant memory. The market is positioned very defensively.
we saw that with Monday's high, didn't we? It just turned into a bull trap.
A classic bull trap reversal. Faded hard. And what's interesting is it faded even after the core CPI revision came in a little bit below consensus at 2.6%.
So the market used that flicker of good news.
As liquidity. Pure and simple, they sold right into it.
Okay, but let's challenge this idea of paralysis, because the trading activity doesn't really support sideline desks.
Go on.
Well, if everyone was on the sidelines, the volume should have been paper thin, but it wasn't. Volume expanded significantly. We're talking 15 to 20% above the 30-day average. A flat index on high volume. Now, my initial read on that says this could be aggressive dip buying finally coming in. Why are you so convinced this was unloading?
It's a fair question. But look, if it were conviction buying, we would have seen follow-through. We would have closed above Monday's levels. We didn't.
Okay.
Instead, all that high volume was concentrated on the break below yesterday's record levels. That is the textbook definition of institutional distribution.
Yeah.
Active money using that high volume, using that morning CPI bid as pure liquidity to get out.
So we're in a sell the news regime.
We are officially in a sell the news regime. Institutions, they're demanding earnings beats now, not just inline macro data to justify these multiples.
So the headline neutrality, it isn't just a lie, it's a cover. A cover for a major shift in institutional posture.
Precisely. And the sector divergence just confirms that flight to safety was blatant. The defensive hideout wore the crown. Utilities finished up a strong 1.2%.
And at the opposite end.
Semiconductors, the core of the AI momentum trade, the clearest laggard dropping 1.5%. We hit a wall of valuation exhaustion there.
So money is rotating out of high beta growth and into a defensive sanctuary.
That's the perfect term for it. And we had specific catalysts for that rotation, two external drivers that really provided the shock.
Let's hit those. First, policy risk. The renewed threats of a 10% cap on credit card interest rates. That absolutely rocked the financials.
It created immediate, painful reversals, and it's a systemic problem. You saw Visa and Mastercard just plummet, both over 4%. This isn't just a simple profit hit for one quarter. This is a regulatory overhang now priced into the entire financial services cohort. It undid weeks of momentum in a single day.
And then globally, geopolitical drag.
Fresh tariff threats involving countries doing business with Iran, that pushed oil up towards $64 a barrel.
And that's a huge worry. It fuels fears of a second-half inflation echo, which completely complicates the Fed's soft landing narrative.
Exactly. Smart money saw these twin risks, regulatory and inflationary, and just decided the market isn't worth holding on to right now.
And that decision was written all over the key reversals today. Let's talk JPMorgan.
JPM was the poster child for the earnings reversal. It slumped 4%, dragged the Dow down 400 points at one point.
But they beat on adjusted profit.
They did.
Yeah.
But crucially, they missed on revenue. That is the pivotal detail. The market right now is so hypersensitive, beating the street isn't enough. The quality of that revenue has to be flawless.
We saw the same strict grading hit Delta Airlines, the guidance fade. It dropped 2.5% despite a profit beat.
Because their 2026 forecast was disappointing. It was a universal risk-off signal. Banking, services, industrials.
Everywhere. Well, almost everywhere. There was one surprising counter-trend move holding up the ceiling.
Alphabet.
GOGL was a true lone wolf. It closed at a record high 331.86. That excitement around the Apple-Gemini partnership, it's clearly sustaining confidence in that very small group of megacaps, the AI sovereigns.
And let's just clarify that term because it's important for the audience here. When we say AI sovereigns, we mean that handful of megacap tech players.
Yeah.
Your GOGL, your MSFT, maybe Apple, whose market cap and cash flows are so enormous, they basically control their own destiny in this AI arms race.
Regardless of the macro noise.
Exactly. And that conviction is what's holding the index up right now.
Which brings us to the internals, the final smoking gun for distribution, because the index levels are pure fiction when you look at participation. What did the advanced decline ratio tell us?
It tells us the K-shaped rally is fully institutionalized. It's fully intact. The AD line closed at a deeply lackluster 0.8 to 1.
So not a rising tide.
Not at all. Capital is flowing narrowly into those few AI sovereigns while the vast majority of the NYSE just bled out. Only 35% of NYSE stocks closed above their 50-day moving average. It's full defensive sanctuary mode.
Now, we typically expect volatility to get crushed on a flat to green day like this, but let's look at the VIX.
The VIX held firm. It was at 16.2, actually gained 1.5% on the session.
Which is the definition of a stress rally.
Textbook. Large-scale players are aggressively buying downside protection. They're buying puts. They're hedging their long equity exposures because they are pricing in a tail risk event for the rest of this week.
So they don't trust this price action at all.
Not one bit.
So we have the VIX holding firm, the AD line showing weakness. But the most alarming sign for me, signaling that this move is exhausted, is the new high new low index.
Absolutely. The NHNL index confirms the deep mechanical weakness. The S&P 500 hit a marginal new intraday high today, right?
Right.
Yet the new high new low index declined sharply. This is a massive, flashing bearish divergence. Price and participation are going in opposite directions.
And historically, that's a major warning sign.
It's a huge one. When the index makes a new high but the internals make a lower high, the engine is stalled out. History suggests a 3 to 5% mean reversion correction follows with very high probability. That's the core warning from today's tape.
So the market is tired.
Right.
And the path of least resistance is now down.
It's signaling that, yes.
Okay, given this internal weakness with CPI looming, let's establish the line in the sand for tomorrow's open. The critical gamma level we are watching is 6,950 on the S&P 500.
6,950 is the battleground. That's where a huge amount of put gamma is clustered. As long as we hold that level, the buy the dip algos, they stay active. It prevents an immediate collapse.
But the risk is immense if it breaks.
A breach of 6,950 triggers a delta-hedging cascade. The next major support is all the way down at 6,840, and the upside, firmly capped at 7,000. That's the magnet of gravity where call sellers are aggressively defending.
So given that today was a rotational liquidation day, what's the strategic probability of a clear directional move tomorrow?
A trend day. Low. Very low. Mathematically, when the S&P closes in this tight of a range, plus or minus 0.1%. The probability of a trend day 2, a move over 1% in the same direction, is only 18%.
So expect an inside day.
Expect noise. Expect an inside day dominated by CPI. The strategic play is to fade the extremes of the first 30 minutes. Unless, of course, the 8.30 data gives us a true shock.
Let's outline 2 concrete day 2 setups for an active trader. First, let's go back to JPMorgan, the earnings narrative play.
Right. Despite that initial 4% slump, the underlying metrics were still robust enough to warrant a second look. We often see institutional re-risking occur 24 hours later once the desk notes on that revenue miss get digested.
So the play is?
Look for an attempt to reclaim ground. Play the long side on a break of Tuesday's high, target 2% above today's close, but with a strict stop loss at Tuesday's volume-weighted average price.
Okay, and leveraging the sector strengths we discussed. NVIDIA.
NVDA is the sector resilience play. It showed clear relative strength today. It held that $150 pivot. And as long as this AI arms race is the core driver, tech can act as its own kind of defensive sanctuary.
So how do you trade it?
The strategy is to play the long side. If it clears its first 15-minute high, but, and this is a big but only assuming the SPX holds that critical 6,950 level.
My preferred asymmetric setup for tomorrow to play this continuing rotation is the long SPY short DIA pair trade. It neutralizes some of that beta risk.
That's a sophisticated trade that really leverages today's analysis. You're longing the S&P proxy, shorting the bank and industrial heavy Dow proxy. You're trying to neutralize your overall market risk.
And profit from the rotation.
You profit directly from that rotation away from old economy value toward resilient AI growth. The embedded risk, of course, is if CPI comes in unexpectedly low, that could trigger a massive relief rally that benefits those rate-sensitive banks in the DIA.
So let's tie this all together. Summarize the sentiment one last time for us.
The market is tired. We saw a clear institutional distribution underneath a flat headline tape. Smart money is buying insurance. The VIX tells us that, not more exposure. The conviction is just gone until we get clean data.
The marginal record high party just got a loud noise complaint from the AD line and the NHNL index. Today was purely a distribution day. Watch 6,950 on the S&P. If we don't hold there, neutral turns bearish, and it turns bearish fast. Respect the fade.
Indeed. And here's a final thought for you to mull over ahead of the open. If the market internals, specifically breadth and that NHNL index, are signaling this much exhaustion before we even get the CPI print, what level of negative surprise in tomorrow's data would it take to break 6,840 and finally trigger that 3 to 5% correction the technicals have been signaling for weeks? That's the real question.